All right, welcome back to Talk Tickers. You know what we do here.
We tear apart earnings calls to find the good stuff, the stuff you actually need.
That's right. And today we've got Blink Charging's Q4 2024 under the microscope.
It's been a buzzy one. The stock's been kind of all over the place, so let's get into it.
Yeah, what really happened?
Well, first off, the big numbers for Q4 2024, Blink brought in $30 million in revenue.
Okay.
Which is a pretty nice jump, 20% up from Q3. But what really pops out are their service revenues. They hit $9.8 million.
Oh, wow.
Yeah, a very healthy 24% increase year over year. And their network fees, those recurring charges, for using their charging stations,
Right.
those also went up to $2.4 million, a 9% bump compared to last year.
That service revenue is definitely catching my eye. What's driving that growth?
Well, a big part of it is how much Blink's been expanding their own charging network. They closed out 2024 with 6,867 company-owned chargers.
Wow.
That's a big jump, 33% more than the year before. And it's not just about adding more chargers. It's about putting them in the right spots and really leaning into those DC fast chargers.
Right, the fast charger.
Exactly, and get this revenue from their DC fast chargers. It basically exploded in 2024, like almost 5 times higher compared to 2023.
5 times? That's wild.
Yeah, think about their deal with Royal Farms, 76 DC fast charging ports that Blink owns and runs.
Okay.
That's a textbook example of their strategy. They're all in on owning and operating those high-use fast chargers, and it seems to be paying off.
Yeah, that's a huge shift for them. And how about utilization? Are people actually using all these chargers?
Oh, yeah, for sure. They set a record in Q4 with 42.5 gigawatt hours of energy dispensed across all their networks, more than double what they did in the same quarter last year. So the demand's definitely there.
Good sign.
Zooming out to the whole year 2024, their total revenue came in at $126 million. Now, that is down from $140.6 million in 2023.
Okay, so a dip there. Why is that?
Well, in 2023, they had a lot of sales from those DC fast chargers to car dealerships. But in 2024, they made a conscious shift to focus on what they believe are more sustainable and profitable areas.
So less about one-time product sales, more about the long game. The recurring revenue.
Exact.
Got it. So how's their bottom line looking with this shift?
That's where things get really interesting. Their gross profit actually went up in 2024 to $40.8 million, a 32% gross margin compared to 29% in 2023.
Interesting.
And this is their total operating expenses when you adjust for non-cash items.
Right.
Dropped by 24% in 2024, and in Q4 alone, operating expenses were down 17% from the previous quarter.
Okay, that's significant.
A lot of that came from cutting down on compensation expenses, a 37% reduction year over year.
Wow.
And here's the kicker. They slashed their cash burn like in half. It went from $18 million per quarter at the end of 2023 to just $9 million at the end of 2024.
That's pretty impressive. They're really tightening their belts.
Yeah, they're serious about getting to profitability.
So where does that leave them in terms of cash on hand?
End of December 2024, they had $55 million in cash and no cash debt.
Okay.
Gives them some breathing room as they move forward.
Right. And their adjusted EBITDA, what's that looking like?
Also showing improvement for the year, they posted a loss of $49.5 million, which is better than the $57 million loss in 2023. So things are trending in the right direction.
Okay, so we've got solid service revenue growth, improving margins, and some serious cost control, even with a strategic pullback on some product sales. But let's zoom out. What about the EV market as a whole? What do they have to say about that?
They're pretty optimistic about EV adoption continuing to be strong. They pointed out that new EV sales in the U.S. were up almost 30% year over year in January 2025. And that's the 10th month in a row with over 100,000 EVs sold.
Wow.
And the used EV market's booming too, sales up nearly 31% year over year in January. So that all points to more demand for charging infrastructure, which is good news for Blink.
For sure. And what about those potential headwinds we've been hearing about, like tariff?
They address that they don't expect tariffs to mess with their gross margins too much because of their production facilities in the U.S. and India.
Okay, good to know. And we've talked a lot about service revenue growth. What else is contributing to that besides just having more chargers out there?
Like we said, the growing number of Blink-owned chargers, especially those DC fast chargers, that's a big one, and they're being smarter about where they put them, so they're getting used more.
Right, location, location, location.
Exactly, and they're also working on merging their European software networks into one global system, Blink 2.0.
Okay.
That should streamline things, make their operations more efficient, and could help boost service revenue even more.
Makes sense. And they also talk about their market position and the potential for consolidation in the industry. Where does Blink stand right now?
According to the U.S. Department of Energy, Blink is currently the third largest EV charging network in the United States.
Yeah.
And all this consolidation happening in the EV charging world, both here and in Europe, it creates a lot of opportunities for Blink. They could grow organically as smaller players struggle, or they could buy up other companies to get bigger.
Right.
And don't forget, Blink already has a pretty big presence in Europe, especially in the UK and Belgium, so their revenue and profits aren't all tied to the US market.
Good point. So they've got this Blink forward strategy they keep mentioning. Can you break that down for us? What are the key points?
Sure. Blink Forward has a few main pillars. First off, they're laser focused on reaching profitability,
Okay.
which means continuing to cut costs. Second, they want to offer a bunch of different business models to appeal to different types of customers. You know, some want to buy chargers outright, some want a different arrangement.
Right.
Third, they're going to really ramp up putting those Blink-owned DC fast chargers in the best high-demand locations. Fourth, they're prioritizing services and recurring revenue streams. Those are the moneymakers.
Okay.
Fifth, they plan to take advantage of opportunities that pop up as the market consolidates.
Makes sense.
And finally, they're committed to being smart with their cash, optimizing their operations, and finding the cheapest ways to raise capital to fuel their growth.
So a very deliberate plan there. Now, their product sales were down this quarter. Do they have a strategy to turn that around?
Even though their main focus is on owning and operating the chargers, they still want to sell to customers who prefer to buy their own charging equipment.
Got it.
So they're working on improving their product sales by using different channels like electrical distributors and focusing on specific markets like local governments. They seem optimistic about product sales picking up in the second half of 2025, and they hired a new senior VP of sales and business development to help with that.
Okay.
They also see potential growth from state contracts in the U.S., like in Maryland and New York, and from European markets like the UK and Belgium.
Okay, let's talk margins. What do they have to say about that?
They didn't give any specific guidance for the future, but they did say that their strong owner-operator business and their improved efficiency in product sales helped their margins in 2024, even though product sales were down. And they think they can squeeze even more margin out of the owner-operator segment by tweaking their fees and using dynamic pricing where prices adjust based on demand.
Oh, interesting.
Plus, they're working on managing their inventory better to keep product margins consistent.
Makes sense. Now, what about their financial strategy and any potential mergers or acquisitions?
Blink is actively looking for ways to raise capital without diluting their shares, to support the growth of their owner-operator network.
Right.
And they're working on managing their working capital better by improving their accounts receivable and inventory.
Oh.
As for acquisitions, they're definitely looking at potential targets, especially in Europe, but they're being picky. They want the right strategic fit, and they're not going to overpay.
Well.
They also said that the planned IPO of their Envoy subsidiary is still on track for this spring.
Anything else noteworthy from the call?
Yeah, a few things. They talked about how they've made good progress selling through electrical distributors, which is a more efficient channel for them. And they see a lot of potential growth in working with local governments, both for direct sales and owner-operator partnerships.
Okay.
The commercial multifamily housing market is another area they're excited about, with new building codes requiring EV charging readiness. It fits perfectly with Blink's model.
Right.
They even mentioned that they're seeing more demand for chargers at existing apartment and condo complexes.
Interesting.
And lastly, they explained that impairment charge they took in Q4. It was a non-cash write-down of goodwill related to some past acquisitions. Basically, they're saying that a previous acquisition isn't doing as well as they hoped, but it doesn't affect their cash flow right now.
Oh, well, that was a deep dive if I ever heard one. Blink Charging's Q4 2024 earnings call. They're clearly all about that high-margin owner-operator model, and they're getting serious about controlling costs. Now it's time for our This Is Not Financial Advice segment, where we throw out a wild but maybe plausible trade idea.
All right, so let's play a little thought experiment here. Blink is going all in on owning and operating those fast DC chargers, and that part of their business is growing like crazy. And EV adoption in Europe, especially in the UK and Belgium, is exploding.
Right.
So what if the UK's LEVI program, that plan to build tons of EV charging stations, really takes off, and Blink, with their strong presence in Europe, manages to snag a bunch of those government contracts?
Oh, I'm following.
Here's the hypothetical play. You could buy Blink Charging, BLNK, and at the same time short a basket of US-based EV charging companies that are mostly selling those slower level 2 chargers and don't have much of a presence in Europe or access to government funding. The idea is that Blink's focus on owning and operating chargers, especially in that fast-growing European DC fast charging market with government support, could make their stock way more valuable. While those other companies that are lagging behind might see slower growth, it's a bet that Blink's strategy and their European advantage will be a much better story for investors than the general US market for level 2 chargers.
Interesting.
But remember, this is just a thought experiment, not advice. Do your own research.
Absolutely. That's some food for thought for sure. Playing on those specific dynamics in Europe and how Blink's positioning themselves now, listener. What stood out to you from this earnings call?
What are you going to dig into?
That's what we're here for, to spark those ideas well. That wraps up our deep dive into Blink Charging's Q4 2024 earnings call. Hope you got some good insights out of it.
Until next time.
Join us again on Talk Tickers when we break down another big earnings report.